welcome to Oz.Fx, and today we're going to talk about some basic Forex terms. After making the last two videos that I made leading up to this, I started to realize that if I'm going to go through this whole Forex basics little video series, I guess you would call it, there's going to be a lot of videos. And while that's okay, I'm going to go into some of these things a little bit deeper later on. But for right now, I'd like to have a video that has a pretty good overview of some of the most basic Forex terms that you need to know. I remember when I first got involved in Forex and I heard things like spread, and I was scared to ask questions about what they actually meant because everybody else that I was around knew what all these terms meant. But you don't know if you don't know. And if you don't ask, you're not gonna know. So with that being said, let's jump right into it. The number one thing on my list right here, none of these things are in an order of importance. It's just how they landed on the list. But number one is pip, and I'll read this right here. It says, generally the lowest and smallest increment in which a currency pair is priced. Pips are used to measure movement in a Forex pair. That's all it is. Pips are just measuring how far your pair is moving. Pip prices are subject to change and can be moved due to the timing of the trade and the amount that is being traded. So this isn't my picture right here. Shout out to FX Trades on Instagram. If you want to go give them a follow, you can. But I've always liked this picture here. And this definition right here is the easiest definition of a pip. It says, a pip is the unit of measurement used to express the change in value between two currencies. That's great. So normally, on all your normal pairs like Euro USD, anything that's not a JPY pair, the normal pip value is this right here. One pip is the second number on the inside here. The second number to the left, this right here is 0.1 pip, and then 10 pips, and then 100 pips, 1,000 pips, and 10,000, so on. You get the picture. But if you were going to come and look at a JPY pair and look at the numbers here, as you can see, there's only a few numbers here, and the pip is this number right in here. So next on the list is all this stuff right here, right? And I'm not going to really read through all this because it's just a bunch of definitions, and anybody can look up the definitions of these things. But usually when you read this, you don't actually know what it's talking about unless you have a picture in front of you, right? So this picture right here kind of tells everything that all this said right up here. So if I want to look at the bid price, it's just the price at which the market maker / broker is willing to buy the currency pair. The value of the underlying currency pair affects the bid price. This is the bid price here. This is the ask price here. And then the difference between these two numbers is what equals to the spread right here. And the spread is just what you end up paying your broker. We'll cover brokers at a later video. But if I were to give you the actual definition of spread, it's just the difference between buy and sell, bid and ask prices. This varies based on your broker. The cost of doing business, this is what you pay your broker. So the base is the first currency in a currency pair. In this case, GBP would be the base, and then this would be the quote currency. This isn't really an idea that you need to focus on a whole lot, but it is helpful to know how to calculate pips and the spread and all that. All right, now we're going to get into leverage. And leverage is where a lot of people get lost. I've said this on previous videos. But to get started with leverage, I'm just going to cover this right here. The means of gaining exposure to larger amounts of currency without having to pay the full value of your trade up front. So kind of like taking a loan. It effectively allows you to trade larger amounts with less capital. For example, a leverage of 1:50 means you could use the initial margin of $200 to open a trade value at $10,000. Using leverage can largely amplify your profits, but it can also amplify your loss. And this amplify your losses part right here, if you know how to manage your risk, you don't really even have to worry about that. But there's a lot of people that go into the market and open up trades without any stop losses. Better you than me, bud. So I have a few pictures here to kind of give you a better picture of what leverage is. And as you can see here, if you put in $100 and your leverage is 1 to 10, you actually have a leveraged value of $1,000. Down here, 1 to 100, if you have $1,000, this is actually what you're trading. And down here is another little chart. Leverage is defined as an act of using borrowed money to increase earning potential. It really doesn't have to be any harder than it is. I'm not gonna go in and break down how all the numbers work and the margin and all that. All you need to know is that you have a margin of like 1 to 100 or 1 to 500. you are actually basically trading with a loan. All right, so let's go down in here to some more terms. A bear market is a market that's on the decline where traders expect prices to fall, which indicates there is going to be more short selling or traders going short. And then the opposite would obviously be a bull market, a market that is appreciating where traders are eager to increase their long trading activity, also known as going long. Now, I'm just going to blow through the rest of these really quick, and I will break them down later in another video, but I wanted to get people familiar with some of these terms. And you get your broker, which is an intermediary for traders and financial institutions to go through for executing transactions. Some examples are Oz.Fx, Eagle.Fx, Cedar.Fx, Prosperity.Fx, and then your bigger known ones that are Oanda and FXCM. And then if you're trading or you're in Forex, you're going to hear about the Federal Reserve, or the Fed, and it is the official centralized bank for the regulation of economic activity in the USA, often abbreviated as the Fed. It aims to control inflation by influencing interest prices. When inflation is too high, the Fed typically raises interest rates to slow the economy and bring inflation down. And what do you think is next? Inflation. Everybody knows what inflation is, but the rate of increase in the price of goods and services in a national state economy. Inflation rates can affect Forex pairs and other traded assets by either lowering or heightening their value. Foreign exchange volatility, it refers to the price fluctuations of a market. The bigger the price movements, the more volatile a market is considered. Basically, volatility is just lots of movement up and down. Interest rates, I'm not going to read all this. Y'all know what interest rates are. If you're getting into Forex and you've never heard of interest rates, go look it up. And then down here is stop loss. It's the distance you are willing to let the trade go against you before closing the trade, losing what you risked. So if you were risking 2% and you had a leverage, so if you're risking 2%, right, and it goes past your stop loss, all you're going to lose is 2% of your account. But this is where leverage comes into the idea, where say you have a trade set up to hit a 1 to 4, for every 2% that you risk, for every 1 of that 4, you get 2%. So you're actually getting 8% of that trade, and that's where leverage can really help you. And then take profit, I kind of just went through that. Where are you projecting the trade to fulfill and take your money off the table? And then there's MetaTrader 4 and 5, which this is where you hook your broker up to. This is where you normally trade. As you can see, I'm on TradingView here. This is where we mark up our charts. And this is a very great platform to use. All the drawing tools are amazing. TradingView is free. So is MetaTrader 4. MetaTrader 4 sucks in my opinion. I hate it, but it's what I gotta use to trade on. But yeah, guys, that's about all I got. I just went through the Forex terms that I had on my list there very quickly. I am gonna go through and break most of these down a little bit deeper and actually explain how leverage works with the margin and the different leverages and all that. I will go through and explain all that. I will go into brokers a little bit more. I will go through MetaTrader 4. I will go through all of these things more. I just wanted to get this basic list of Forex terms out to you guys so that you guys can start to get familiar with the lingo of Forex, I guess you would say. But other than that, guys, I'm out of here. Until the next one, I'll catch you later.